When a company buys a debt security, they are establishing a strict, legally binding creditor relationship with the issuer. They are lending money, and they expect it back. Under U.S. GAAP, this category extends beyond standard corporate bonds. It explicitly includes instruments like collateralized mortgage obligations, as well as preferred stock that must be redeemed by the issuer or is redeemable at the investor's option. Even though preferred stock carries the legal title of shares, a mandatory redemption feature creates a fixed obligation to repay cash. That creditor-debtor dynamic forces it into the debt accounting framework. Conversely, contracts that do not represent a traditional lending relationship, like leases, financial options, futures, and forward contracts, are strictly excluded from this category. Confirming an asset meets this strict definition of a debt security is the required first step. Once classified as debt, every subsequent journal entry depends entirely on the purchasing company's internal strategy. Consider a scenario where 3 different corporations purchase the exact same 10-year corporate bond on the exact same day. At the end of year 1, market interest rates rise, causing the fair value of all 3 bonds to drop by $50,000. When financial statements are issued, the first company reports a $50,000 loss directly in its earnings. The second company reports the same loss, but hides it inside an equity account. The third company reports no loss at all. The underlying asset is identical, but the accounting measurement basis is dictated by management's intent and ability to hold that asset. GAAP divides this intent into 3 distinct categories: held to maturity, trading, and available for sale. Whether market volatility flows through to the income statement, gets parked on the balance sheet, or is ignored entirely hinges entirely on which of these 3 classifications management selects at acquisition. The strictest classification is held to maturity. To use this category, a company must have both the positive intent and the financial ability to hold the security until its exact maturity date. Because the company intends to collect the stated principal and interest over the life of the bond, these securities are reported at amortized cost. This is the initial purchase price, adjusted for any unamortized premium or discount. The day-to-day fluctuations in fair value are ignored. A firm cannot classify a bond as held to maturity if they merely intend to hold it for an indefinite period, or if there is a possibility they might sell it early to supply cash or avoid interest rate risk. There are only 2 narrow exceptions where a sale does not taint the portfolio. The sale must occur extremely close to maturity, usually within 3 months, or after the company has already collected at least 85% of the principal. By isolating the asset from the daily chaos of market swings, held-to-maturity accounting ultimately prioritizes the absolute certainty of long-term contractual cash flows. At the opposite end of the spectrum are trading securities. These are debt instruments purchased primarily to be sold in the near term, generating profits from short-term price movements. Because the goal is immediate profit, trading securities are remeasured to their fair value at every balance sheet date. Any unrealized holding gains or losses are recognized directly in the income statement. Look at this source problem detailing Suncorp's portfolio. The firm acquired trading debt securities with an initial cost basis of $650,000. By December year 1, the fair value of those investments had fallen to $575,000. Even though Suncorp has not sold a single bond, they must write down the asset to its current fair value and report a $75,000 unrealized loss in their year 1 net income. For trading portfolios, the income statement absorbs every ounce of market volatility in real time. The final category, available for sale, acts as a catch-all. If a debt security does not meet the strict criteria for held to maturity and isn't actively traded for short-term profit, it defaults here. Like trading securities, available for sale assets are remeasured to fair value at each reporting date. However, the resulting unrealized gains and losses bypass the income statement entirely and are instead reported in other comprehensive income, or OCI. In year 3, Ball Corporation's available for sale securities costing $150,000 dropped to a $130,000 fair value. This $20,000 loss bypasses earnings and is parked in OCI. By year 4, the fair value rebounds to $160,000. To adjust the balance, Ball records a $30,000 increase to OCI. This wipes out the previous $20,000 deficit and establishes a $10,000 surplus. Available-for-sale accounting effectively provides accurate fair value transparency on the balance sheet, while insulating the core earnings metric from temporary market noise. There is a strict override to this protective buffer. If the decline in an asset's fair value is deemed other than temporary, the normal available-for-sale rules are suspended. When a permanent impairment occurs, the asset's amortized cost basis is forcibly written down to its current fair value. The resulting loss bypasses OCI and is recognized immediately in the income statement. An available-for-sale security costing $75,000 suffered a permanent impairment, forcing a write-down to $30,000 in year 2. Crucially, this new cost basis is locked in. GAAP prohibits reversing the impairment, even when fair value bounces back to $60,000. Despite DOT's subsequent $30,000 recovery in market value, Smoke's net income for year 3 remains completely unaffected. The recovery is treated as a standard unrealized gain and parked in OCI. Impairment accounting forces negative outcomes into current earnings instantly, but mandates that any subsequent market recoveries remain trapped on the balance sheet. Because business strategies evolve, GAAP requires companies to reassess their debt security classifications at each reporting date. Returning to the Suncorp dataset, management changes its strategy on June 30th, year 2. They decide to hold the investments indefinitely, requiring a reclassification to the available-for-sale category. When a transfer occurs, the security is moved at its current fair value. Any unrealized changes in value that occurred prior to the transfer must be accounted for under the rules of the old classification. Between December of year 1 and the June transfer date, the fair value of Suncorp's portfolio dropped further, from $575,000 down to $530,000. Because the bonds were legally classified as trading securities during that specific 6-month decline, Suncorp is required to recognize that $45,000 loss directly in its year 2 earnings. The entire regulatory framework rests on a strict matrix. Held to maturity uses amortized cost and ignores market fluctuations. Trading uses fair value and hits earnings. Available for sale uses fair value but routes fluctuations to OCI. Only a deliberate reclassification by management, or a permanent impairment in the market, allows asset values to break those routing rules and cross the boundary between equity and earnings. 3 companies can hold the exact same financial instrument, experience the exact same market events, and legally publish 3 entirely different net income figures. Mastering debt security accounting requires looking past the asset itself. The correct journal entry isn't determined by the bond market. It is determined by the specific intent inside the boardroom.